Righto, money miners.
That's not enough, Ali.
Oh, no, come on. I'll let you.
The three of us will do it all together, mate. Maybe we'll get one match.
Yeah.
3, 2, 1.
Righto,
money
miners.
Does 3 make 1?
3 makes 1.
Almost
one
got there.
Maddie. There you go. Guys, we've got like a bit of a variety show today. We've got global news out of China. We've got deals. We've got financings. It's all happening. It's like a Christmas pageant.
Super large caps, very small micro caps, and a bit in between, Ali.
Your specialty, Trav, going right down into the micro cap land.
Mate, this is, on the lower threshold of what I normally talk about. But it's kind of an interesting thing. But it's one for the silver bugs too, but or lead bugs. Don't think there's any lead bugs out there. We'll get there. But yeah, like keen to talk about it. Keen for Christmas too. We're on the home straight.
We're close. We're
Few
close.
business days left. Not
Yeah.
that we're counting.
Some big news out of China.
Yeah, no. So, big article out today that I think bloody everyone would have seen, and certainly the markets would have seen the news out of China signalling bolder stimulus for next year as Trump returns. So, the Politburo, I'm not sure if I'm saying that correctly, which is basically the ruling Communist Party's most senior sort of 24 officials, led by President Xi, announced they will embrace a moderately loose strategy for monetary policy in 2025. So, signalling more rate cuts ahead and shifting from a prudent strategy that's been held for nearly 14 years to now a moderately loose strategy.
Is this why all the lithium stocks are up, Ali?
Yeah, this is but everything.
Not just
base
lithium,
metals, lithium, everything's up massively. Commodity price wise, most things are up at 1%, 2%, 3%, and the equities even more so.
About time. Like, jeez.
That's like a little China Santa rally.
It's the
Love
first
that.
day that commod stocks are looking like meme stocks.
Will it hold though? We've been talking about China stimulus for a number of months now, and it's faded pretty quickly. So that is the big unanswered question. Hey.
Yeah, so one to keep an eye on, and as we sort of said, JD, like, and people, sort of raising the question, like, this is all good, but very positive, but how's it going to be implemented is not totally clear just yet. So certainly one to watch. But going to one of our biggest stories for today is Lundin Mining selling some of their assets to go pretty much all in on to Vicuna. So take us through it, JD.
Yeah, an interesting sale. It had been one that's flagged for quite a while. So Lundin Mining will sell Neves and Zinc to Boliden, Boliden being a Swedish miner. So I'll give a bit of a big rundown, but the headline is US $1.5 billion transaction. So the money miners might remember we spoke about one of these assets in particular, Neves because a lot of the Aussie miners were looking at this one. They'd been in the data room. You had the likes of Mac, S32 were named. I'm sure Sandfire were looking as well. Yeah, so our first thoughts were, how does the price stack up against the recent copper transactions? We've heard a lot of CEOs of big miners saying copper deals are, priced pretty richly. We've seen that ourselves. One that comes to mind that we spoke about a little while ago was the Comacao transaction, but you've seen it for years now. So it was worth getting into the weeds.
Is it fair to categorise these as copper mines though, or are they
no
zinc mines?
So Neves is more copper dominant, but Zinc literally translates from Swedish to the zinc mine.
Gotcha.
And forecast for 2024 was about 80,000 tonnes of zinc and 5,000 tonnes of copper from that operation.
Gotcha.
So to give the run through on the miners and the assets just quickly, because I don't think a lot of the Aussie listeners will be too familiar with them. You've got Lundin Mining on the one hand, TSX listed. They're capped at just under $11 billion in Canadian terms, predominantly a copper miner, and this transaction makes them even more so a copper miner. They do a good bit of zinc at the moment and some gold as well. They've got stakes in Candelaria, Caserones, Chapada and more, and of course the big BHP deal, which you touched on there, Ali, being in the Vicuna. So
from the moment they announced the Vicuna transaction with BHP, that they always said, okay, we're gonna sell down our other assets in order to kind of forge a pathway ahead to fund.
Yeah, and they need to
development here of
to delever a bit before they have that big capex cycle. That's sort of anticipated to start in 26, and a lot of money's got to go into the ground there.
Maria to kick things off, and then there's still a fair bit of work under the bridge when it comes to Filet del Sol too.
Yeah, absolutely. So of course you've got the Lundin family there as well, about 15% of the stock in Lundin Mining. Then you've got Boliden. So they're a Swedish miner and smelter, importantly. So you've got a bit of vertical integration there. Market cap in Aussie dollar terms around 13 billion. Operations mainly in Scandinavia, but they've got the Tara mine, which is pretty well known in Ireland as well, actually shut down not too long ago and is getting restarted. So strong zinc focus, and then sort of copper comes in behind that. Learning more about Boliden, it was, one of the first things that came to my mind is, are they just trying to lock in concentrate supply? You guys will remember we spoke a lot at the beginning of the year of these smelters around the world feeling the pinch of not being able to get their hands on copper concentrate with the likes of Cobre Panama and other mines shutting down. We saw a dramatic fall off in the TCRCs that these smelters charge. And, that is no different in Europe. That was predominantly focused in China, but we saw in Indonesia, a bit in India as well. But it's no different up here. And that means the smelting part of their business has kind of been suffering. And the answer I kind of came to on that was like, in part, yes, they're definitely trying to address that. But that is a bit of a longer term view because, of course, the operations that are being bought here have contracts in place already that you can't just change. A lot of the supply was actually going to Boliden already, so it doesn't change. And the other stuff was contracted out, so it's going to take some time before you yourself get your hands on that after buying the mines.
I would have thought the dynamics in this, like the smelting market, like the negative TCRCs or whatever, it's like a short term phenomenon because it's just like you can't have a long term like downstream smelting industry that's unprofitable. Eventually, you'll have supply curtailment, less smelters available. The ones that remain are more profitable. But there's just been like a lack of shutdowns in some of these unprofitable smelters by virtue of whatever industrial policy settings are in these countries at the time. But that doesn't last forever. That's just a short-term phenomenon.
Nah, people aren't going to be attracted, sort of 101 to a market that's uneconomic, and that plays out over quite a while with a bit of sort of influence from governments, right? Like you look at Indonesia, and the government forced them to build that smelter, the Freeport one, and those sorts of things. So there's, you see that in commodity markets.
So tell us about the two assets that Boliden are buying off Lundin.
Yeah, so
what are they?
We'll start with the Portuguese asset. This was the one that the Aussie miners were rumoured to be more interested in. So it's an underground operation, polymetallic. It's a VMS deposit, predominantly copper and zinc, sitting in that western part in Portugal of the Iberian Pyrite Belt. We've sort of been hearing for quite a while that this will be kind of consolidated. So the 2024 guidance, like I said, just under 30,000 tonnes of copper and 115,000 tonnes of zinc. C1 costs around about $2 US a pound in copper terms, plus 110 million in capex. So that is, that is not the norm. That is a big swing of capex to get the operation kind of humming again. It's got two processing plants, given the polymetallic nature. Think of Adriatic and these sorts of operations. You've got your copper and then your zinc, which can do a bit of copper as well, a 2.8 and a 2.5 million tonne per annum plant. And it was interesting, they noted in the call, this one actually produces a dirty sort of con with elements that attract a penalty.
What are they? It's like arsenic, or what's the...
I'd imagine arsenic. They didn't sort of reveal, but these sort of household names on it when it comes to those sorts of stuff. So underground mining's been happening here for over 30 years now. So it's got a long life. Although unfortunately, 4 people have died in the past 4 years. So not up to scratch, needless to kind of say, and let's hope that can kind of be stopped going forward. Boliden also call this an asset that sits on the 75th percentile. So it's not often a company will call out an operation that they're buying as being between the 3rd and 4th quartile.
Yeah.
So, I mean, good on them for that sort of disclosure. But, by no means is this a standout asset. And if you just do back of the envelope math on 2024 numbers, assuming a $4 a pound copper price, this makes less than $15 million, again, with the big caveat that is a large amount of capex, and that's not the norm. So cash flow should improve going forward, but high cost curve, like a few of the other operations that Boliden own, which leaves you susceptible to the swings in commodity prices. Then you've got the other asset in Sweden, Zinc Ground. So again, polymetallic right in Boliden's backyard. Lundin actually bought this 20 years ago from Rio Tinto. This mine has a huge history. It's been in continuous operation since 1857. So it's deep now. 3 shafts go down. We're operating around 1,300 metres below the ground. And like I said, 80,000 tonnes of zinc guidance with 5,000 tonnes of copper guidance. In zinc terms, we're talking cash costs of 45 cents plus 65 million capex. So again, back of the envelope, that's about $100 million in cash flow for the year. So not too bad at all. And just on where this sits in the cost curve, in the middle of the second quartile. So much more competitive than Neves Corvo. And, notably, these assets don't have a massive mine life, less than 10 years, where we're talking about
Is
here.
that just based off current reserves? But,
Exactly.
But it's been in
going
operation
forever.
since 1850s.
Yeah.
It
So
keeps going.
So with Zinc Riven, there's a strong expectation that resources will convert to reserve. You don't have quite the same confidence with Neves Corvo. It's a bit higher. There hasn't historically been as good a carryover from reserves to from resources to reserves rather. But I think there's an expectation in buying these assets, that the life will go on for a bit longer.
And what about the price tag here? So Boliden's paying US 1.5 billion, right? That's when you kind of just like think of the multiples here, does it screen fully valued? Does it screen cheap?
It's kind of interesting, right? So where I came to ultimately is that it's kind of at the upper end of what you'd call fair, but there's always many ways you can sort of slice and dice it. So 1.3 billion is what they're paying up front. On a sort of cash-free basis, you might see 1.37 quoted. There's a little bit of sort of money that'll sit in the account that they'll kind of pay for as well, plus 150 million in contingent payments. It's not subject to too many things, given it's not the core assets of either of these companies. But getting into the sort of multiple and how they talk about it, Boliden forecast 300 million to 350 million EBITDA over each of the next 5 years. So if you're conservative on price forecasts, and therefore you don't assume the contingent $150 million payment, and you take the lower of the $300 to $350 million forecast that they assume over each of the next 5 years, you're talking about 4.3 times EBITDA. Now that's definitely worth looking at a bit closer, because these two operations did in 2023 $195 million in EBITDA. So if you're looking on those numbers, just looking back, 6.7 times, and these are operations that have been working for quite some time, so you can get a good feel for it. Like I said, they did come out of that cycle of heightened capex, so that adds a bit of conservatism to it. Interestingly, listening to the call, in that number, $300 to $350 million, the company said they've assumed no synergistic benefits, and that kind of surprised me. It's good to see. It's conservative. Like, I firmly believe there will be synergies here. You can see that because Lundin are paying Boliden right now the TCRCs, so that in time will be scratched and there will be some sort of synergies. But again, you've got more than $100 million difference from what the operations did in 2023 to what these guys are assuming going forward. And you want to dig into that. You want to understand whether that comes from the consensus pricing assumptions, or are they assuming cost improvements, volume growth, these sorts of things. It was a little bit frustrating on the call on this point, because the company just kept on referring back to the point that they don't own the assets yet. They can't comment on costs. They can't comment on this. They can't comment on that. So it was kind of hard to work out. And they also didn't specify exactly what the consensus price forecasts that they're using are. The one detail they did give, though, that it doesn't exceed the contingent payments, which means it's below $4.50 copper and retreating in the coming years, and on the zinc side of things, below $1.40 rather a pound and retreating over the years to come.
Gotcha. I've got 2 points to make there. One's just in relation to EBITDA. What's not captured there is near-term capex. Whenever a company runs a sale process on assets that they're selling, I always assume that the seller halts a lot of capex in the 6 months before the sale completes. So there's probably some catch-up capex to embark on here as well.
Completely agree. I mean, it's kind of the human thing to do, which makes it all the more interesting, because of course, Boliden are going to want to say they got a good deal, but they were very firm in saying this has come at the end of a capex cycle. 110 million is not the norm.
Let's see.
That is big, but
Yeah.
you know, like we said, it's not a standout asset, and there's a good chance more capital will need to go into it. We'll kind of see.
The other point is
that
just
one.
on the copper price there. So contingent payment above 450. So
Yeah.
this is one of the interesting bits of feedback that came out of some of the analyst site visits to the Chilean kind of copper assets of BHP, etc. That happened, I think, 2 weeks ago now. It's like well reported now that BHP is using a long-term copper price in real terms forecast of $4.50 to make investment decisions at the moment in real dollars, which is pretty interesting. It's above consensus, but that's where BHP sits, and they'll have an economic model to point to suggest that. But yeah,
100%. You've got to have your own view as a miner. I did see in the past couple of weeks a few people dial back their copper forecasts for sort of 25 and 26.
Yeah.
Again, as you know, China impacts and these sorts of things that come into account.
It's just when you look at the development assets, you're like, all of these assets need like $5 plus copper to justify development. So,
yeah, absolutely. Digging into how these guys are financing it is kind of interesting. So they're going to pay for it with a bridge loan to start with, and then they're going to refinance this with a share issue corresponding to half the value. So they've flagged straight up that they're going to raise about, you know, what could be US $650 million via a placement or rights issue, which is more common in Sweden. Does need approval. They need to speak with the owners of the business, and that could be carried out in the first half of next year. But it's not a super ASX type thing to sort of see
different,
that.
hey?
Yeah, that you're doing a transaction, you're doing it today, and you're going to raise capital in 6 months' time. That's not something you see every day, and it also does beg the question on the dividend. They've paid dividends for quite some time. They sort of consistently do that, but they're expanding upon their net debt to, you know, their gearing ratios on a few different sort of metrics, going out of the bands that they kind of provide, which does kind of bring about the question, like, why didn't you just sort of minimize or sort of pause the dividend if you knew you were going to do a transaction like this? And again, they sort of pointed to these kind of Swedish rules where you can't speak with the owners of the business whilst you're engaged in a transaction. I hope it doesn't come from a place of apprehension to stop the dividend kind of at all costs, because in the long run that just costs you more. You end up paying more in fees to raise the capital, you know, via issuing share, on top of having the overhang, which could force the stock in itself down over the next 6 months. But we'll see on that one. There's a few sort of intricacies and a few learnings on my part in this one, given it's a Swedish company, things that are a bit different to how companies operate in Australia.
So overall, your takeaways on the deal: good, bad, indifferent?
Just going back from Boliden's perspective to start, from the buyer's perspective, going back to the price. These are producing assets with a long history. If we're conservative, when we look at 2023, copper averaged about $3.85 a pound, zinc about $1.20 a pound. That's a 7 times EV to EBITDA transaction. Like I sort of said, that is
7 times EBITDA.
Oh,
You don't have to say 7 times EBITDA.
okay,
It's the deal EV is the value.
my bad.
That's all right.
It's 7 times EBITDA transaction. So that's the upper end of what you'd kind of call fair. Looking at the brokers' NAVs, it gets kind of interesting. There is a massive range. Obviously, this comes down to the assumptions they've each plugged into it, but you're getting some brokers calling it 0.7 times, some calling it 1.6 times. Looking at the blue sky briefly, it's not how we tend to kind of operate, but there are definitely potential synergies, like I've sort of mentioned. You've got potential commodity upside and optionality in the mine lives, you know, specifically looking at Zinc Ground. There is a strong likelihood that this will sort of see multiple cycles. And operationally, there was also this tone throughout the call that they believe they can pull down OPEX. They didn't say it explicitly, but they kept on kind of hinting at it. Remains to be seen on that part whether they can do it. All of those things are blue sky. You don't want to have to pay for any of them. So gut kind of feel is you wouldn't have wanted to pay any kind of more than they have, especially extending your leverage to buy assets that are in the 75th percentile. That's a risky strategy, and can put you in a bit of strife down the track. Rather, these multiples are a lot higher than we talked about with the coal sales over the past year. No surprise in that one, but I think there's a chance that this one sort of turns out well and they make cash.
They bought an asset in their backyard, right? These are Swedish miners that bought like a nearly 200-year operating zinc mine in Sweden.
Yeah, they'll have a great understanding from it. They've got smelters in the vicinity, particularly again on Zinc Ground. I think it makes more sense than it would have to any other miner out there. Yeah. They could reap more benefits from this than any other name out there. So yeah, makes sense on that part. And for the Lundin side of the equation, again, this was super expected, very much in line with the strategy that they've put forward. And just helps them importantly de-lever before that big capex cycle. It simplifies the business. America's focus. They're not got assets in Europe anymore. And, from an earnings perspective, you're giving up that short term. I think analysts were sort of calling it 20% of their EBITDA in the near term for the Vicuña optionality for the big prize in the long term. And, I think that's the kind of right way to go about it.
I think it was I don't know which, it might have been, I can't remember which Lundin it was, but there was like a quote that every mine that he ever sold, he regretted. It was like, a quote about that. And that's why the family has a reputation of being like very long-term thinkers, because there's, you're making this decision to sell these mines because you've got the bigger picture long-term in mind in Vicuña.
Yeah, there's a trade-off. You can see on their website, sort of scrolling through, like 10K in the DRC was one of them. There's a number of them, and it's interesting history for this company. But yeah, we'll sort of see. You got to kind of give up one thing to keep it all in balance to go for the bigger prize.
The next one. Absolutely. Yeah. I mean, geez, Jadu, we've got a lot happening all over the world as part of this deal. We've got, selling base metals assets in Sweden and Portugal, putting that money to copper assets in South America. I mean, the only guy I know who's this global, other than the very infamous Mr. Worldwide Pitbull, is mining's Mr. Worldwide Steve Tarr from CRE. I mean, look at it. Tari's sorting out insurance policies for all sorts of mines, all sorts of commodities, all over the world. And not just, I know we talk about the producing mines a lot with CRE, but they can help out at the exploration and development end as well. But also even all the drilling, engineering, and all the other contractors that, service these projects too. So they're bespoke, they're comprehensive.
The service providers need insurance, big time, Ali.
Everyone needs insurance. Everyone needs it.
Mate, sometimes people don't pay. Like, you just got to have insurance.
Got to be all over it.
Yeah.
So you want the CRE team on it. It's bespoke, comprehensive. It's tailored to your project, your business. What more could you want?
Ali, can I just say, it's a bit peculiar to me that you draw out the parallel between Pitbull and Tari, because while Tari is CRE's Mr. Worldwide, I actually think you're doing an injustice to the big man, MD Dave Harrison, who's, best I can tell from this image here, could in fact actually be Pitbull's long lost brother. Actually, it could be Pitbull himself. Dave is Pitbull. Get in touch with CRE for bespoke insurance.
Look at that.
Go CRE insurance.
Go CRE.
Alrighty, let's go down the market cap scale. And
just a little bit.
And bring it back home to WA as well and talk about Boab Metals.
Boab, yeah, mate. This is a story for the small cap silver bugs out there. JD Ali, it's one of those projects. It's been kind of hammering away for years trying to get finance, but has never quite gotten there. It's Boab Metals and their Sorby Hills silver lead deposit right at the top of Western Australia. There, it's near the Northern Territory border, and it's about 50 kilometres north of Kununurra. Boab, they own 75% interest in the Sorby Hills project, but they also have an option to acquire the remaining 25% too. And it's just got a mere market cap of $35 million. The stock went up 15% today on the back of a prepay deal with Trafigura, the commodity trader. And in a nutshell, Trafi has agreed to give Boab US $30 million up front. Trafi will get paid back within a 5-year term following like an 18-month interest-only period at a cost of SOFR plus 5% margin. The kicker is like Trafi will get their hands on 75% of Sorby Hills concentrate, which is, at the moment Boab's kind of entire share. Mm-hmm. And if Boab actually opts for, alternatives or financial close isn't achieved, Trafi still gets a share of the concentrate. So as usual, the traders always win, but sometimes you can win too. But
You've got to put food on the table.
Yeah.
So let's look at the Sorby Hills project economics.
If you look at the project on a 100% basis, Sorby Hills has a reserve that contains 19 million ounces of silver and 531,000 tonnes of lead contained. The grade doesn't shoot the lights out, like 3.5% lead and 39 grams per tonne of silver. But there was a feed study in July which suggested a pre-tax NPV of $411 million, pre-tax IRR of 37%. But it's the capex that has always been the big obstacle for the longest time for Boab to find a way to fund. Upfront capital in the latest study is $264 million. So when you think about that kind of capital intensity, or even just your NPV to capex ratio, it's not the world's most financeable project on current assumptions.
And then a 35 mil market cap as well makes that challenging too.
100%. We cut our teeth in the equity kind of world, and it's like to finance a project, you always think about like a big chunk of the financing has got to come from equity in some way, shape, or form, and your ability to stump up enough equity into the project, it's like directly proportional to the size of your market cap in a lot of ways, because that's how much dilution existing shareholders are willing to do. That's how it's just the lower your market cap, it gets really, 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 really difficult to raise sufficient equity to fund these chunky kind of capex numbers. Not that $264 million is a chunky capex number, but when you've got a $35 million market
in
cap,
relative terms to those things.
Yeah, and once upon a time, I thought NAIF was going to stump up some money, but I had a look, and it feels like things have gone a bit quiet on that front for the last few years, which begs the question. At the assumed commodity prices in the study, like the lead revenue is about 3 times what the silver revenue is in this project. So it's really a majority lead project, which for the silver bugs out there just means that the project actually has a negative all-in sustaining cost per silver ounce after the lead credits. But that's not how you should think about these things. We know that. It's
other way around.
Don't let that get in the way, mate.
Granted, like the spot silver price is about 28% higher than the study price, but it swings the other way for the lead price assumption. So swings and roundabouts here.
So all up, what have you kind of come to with the project now?
I think there's just a few things to keep in mind here. Like, remember how I said Boab has an option to buy the remaining 25% of the project? In order to do that, they'd have to stump up stage payments that aggregate to $23 million to get there. But that option is subject to Boab reaching FID by about September next year too. They could always extend that longer if they agreed. But keep in mind there's a goal to announce FID by September. In order to be able to get that option over the line. If they can build on the financing momentum from the announcement today, maybe they can get there too. I remember Sheffield had a similarly insurmountable task trying to finance Thunderbird, but they found a way, and they this funky JV and strategic partner and NAIF came in, and all of a sudden this very undemanding market cap got like sufficient capex to fund the development of Thunderbird, which seemed like impossible. So NAIF would make a massive difference, but I'm not filled with confidence given the lack of discussion about NAIF for a few years now. I think of it as a really advanced coal option, like if silver soars on the back of solar demand and lead manages to hold up, then it's a really advanced project that can kind of get into production pretty quickly. There's a lot of work that's been done here, and you can move pretty quickly in that environment where you've got your ducks in order, right? But if commodity prices stay where they are, then I think it could be a tricky proposition in the near term to actually get the financing required to build the project. Personally, I think the supply and demand outlook for silver is it's really healthy, but I'm a bit more trepidatious about lead. Again, what do I know? Commodity price forecasting is hard. And we can't forget that like lead is the vast majority of the revenue here. I think it's one to keep on the watch list, but don't be surprised to see it trade like a call option if silver moves. Like I remember in 2020 after COVID, this thing like went up like 540% in like 3 months, just because like the silver squeeze was on for a period there, and it's kind of given up all of those gains. But that's just the way that
mad.
kind of call option type projects trade, right?
All 5 silver names on the ASX did. I remember.
Yeah, that's crazy. Yeah.
Shoot through the ceiling.
That's the point. All 5 silver names. Yeah. The ASX is like it doesn't have silver names, and the actual silver miners, like not like we like there are pure play kind of silver miners out there, or majority pure play silver miners out there. They ain't listed on the ASX.
Yeah.
Right.
Good stuff, mate.
No, so Trav, it sounds like it's a pretty advanced project. It actually reminds me of a chat we had yesterday as well.
I think I know what conversation you're talking about, Ali. Is it the one about the team that helps companies with advanced projects get past all the red tape and get their deposits into production ASAP?
I think it is exactly that conversation.
It's actually, like, when you think about it, it's actually pretty awesome, right? Because say you're sitting on a project, it's an advanced project, but you don't know, but there's still going to be a fair bit of work to get done in order to get the tick off to actually start mining yet, right? You can have things advanced, but there's still a bunch of stuff you need a bit of help to get in order, right? That's where a seriously capable technical services team comes into the mix.
I think I know which guys and gals you're talking about.
Is it MMS?
Absolutely.
Oh,
MMS got their new technical services team.
I'm even wearing the t-shirt.
You even
Ali.
got the polo today. Love it.
We all know MMS are just the best open pit mining contractor on the block right now, but it might be news to people that they have built out a technical services team that is akin to the Australian Test cricket team of 2006.
Oh, jeez, that's a big call. Love it.
They just don't lose. That just like that Test cricket team, they didn't lose. Look at the hires lately, right? Nathan Ram, Emma Edwards, Juan Rusi, Rob Seal, like catches win matches. LAJAD, and this tech services team takes a lot of catches.
Well said. So if you need an elite team to help you get the house in order to start moving the dirt, it's these guys. And then you've got the open pit expertise that overlays it all for a full turnkey solution. What more could you want?
Go MMS. Love the t-shirt.
Alrighty. Last one for the day. Develop. It was a little ding, ding, ding for me. So this is Develop basically completed all the docs for their $100 million loan prepay facility with Trafigura.
Two stories.
Another Trafigura one today.
Market like this one too.
Yeah, I wasn't sure if it was the sort of whole China thing going on because everything else was up. Maybe probably a
Bit of
combination. Both. Yeah. So they announced that, like I said before, all the documentation completed for a $65 million prepayment loan facility with Trafi to fund the restart of the Woodlawn copper zinc mine, up around 10-ish% last time I looked. And so it's basically the financing plus that's associated offtake agreement. All of this, to be fair, was all announced back in August. So it's not so much new news here. It's more the fact that all the documentation's complete itself. So Woodlawn is sort of now fully funded through to production. Just a bit of a high-level refresher of the key terms. So Trafi will give Develop around $100 million Aussie in the form of a prepayment/loan facility. The interest on that is BBSY, which is basically a base rate plus a 2% margin, and props to them for actually stating the margin. This is for a term of about 4.5 years from drawdown. And as part of the financing, they've also entered into a 5-year offtake agreement. And this is for 100% of the copper, zinc, and lead/precious metals cons produced from Woodlawn over this period of time.
So that'll be all of the con, right? There wouldn't be anything. Yeah.
And so repayment of this prepay loan facility can be done by way of a set-off against the payments against the offtake agreement, or they can just do quarterly cash payments. And there's no repayments required for the first 18 months of the loan. And the last couple ones is Develop also has the option to sell up to 20% of the output of the project, the Woodlawn project, to third parties, and no mandatory hedging is required. So we'll just flash up the key terms for those two ones there.
At 20%, that's something that Bill's talked about for a long time. Is selling down 20% of Woodlawn. But yeah, feels like it's been a long time. He's been talking about that. Maybe maybe this is the catalyst.
Yeah, and look, yeah, like you said, Trav, it's sort of a pretty common bullet point that pops up in the last few, investor prezos and things like that. So perhaps now that this financing's in place, that might be the catalyst for that. Actually, in the other catalyst being, so what's the actual real new information in today's announcement? So they advised the processing plant refurb is 50% complete now. I believe GR Engineering's doing that. They're on track for first concentrate production in the June quarter next year. So all production from the underground is scheduled to commence in the March quarter next year, so the quarter before. And the Develop Board has now actually made a formal FID, final investment decision, to support the Woodlawn restart plan. So
Gotcha.
I want to just briefly revisit the project economics for Woodlawn.
Sorry, I'm laughing just because you're revisiting it, but I remember how many revisits developed it themselves, because it felt like every couple of months there was an updated restart study with a higher
Maybe
higher
it's
IRR
a pun
because-
intended. I don't know. So they put out an update in August when they initially announced this financing package with Trafi, and this was an update on the April numbers, which basically was what's changed is basically the change in the capex costs, and because of the recently agreed offtake terms with Trafi, they incorporated that, and that would really deliver the main improvement in a lot of the economics, because the TCRCs, the treatment and refining charges, were improved. The commodity price assumptions, actually, they kept the same as what they had in April. So what are we looking at? Sort of pre-production capital, which, includes working capital as well, 78 million. In April it was 67, so not too big of a change there. But a pretty chunky change in the pre-tax NPV from 658 to $728 million there as well. And in light of yesterday's conversations about commodity price assumptions and things like that, I wanted to actually take a look at that here for Woodlawn. So they've got a nice little table in that release from August, which shows the average realised mine plan commodity prices, so over the 10-year mine plan. But really, I think the more important period to look at is what are they assuming in the first sort of few years, which is arguably the riskier period of the mine life, when they're ramping up, when there's debt repayments due and things like that. So I wanted to look at how do their assumptions in the first 3 years compare against current spot prices and sort of consensus economics forecasts. And for those who don't know, consensus economics basically averages out all the different various banks' forecast commodity prices. And when I had a look, they actually, in pretty much all instances, what developer forecasting in those first 3 years are below current spot prices and below what consensus economics forecasts as well. With the exception of lead. Lead's, what they're saying for lead is around where spot is at the moment, and what consensus economics is forecasting. Zinc developed zinc assumptions are largely in line with consensus economics, but spot actually is trading a bit higher, and we'll flash up what they've got in their schedule there. So,
Gotcha.
So all up quite comforting.
yeah, it's encouraging. You'd rather some conservatism and wriggle room as your base case, and you know what? If spot or whatever that price is at that point in time in that first, second, or 30 is more, how good's that? That's a bonus, but. That's the thing is that's an upside. It shouldn't necessarily be your base case.
You know what I'd love to see, Ali? Is
What's that?
Is now adjust those commodity prices for the, for all of the terms and conditions where Trafi takes a little bit off of it. The qualifying period look backs and all that sort of stuff.
Yeah, so there's that to think about as well. And the other sort of key thing to note is the first 2 years of production are already fully developed, and the grade control drilling has been completed, and all the underground capital infrastructure has been installed. So, as we all know, and we've spoken a bunch about on the podcast, is restarts and ramp ups are not without their risks. But things like this, advancing development, grade control drilling, being, sensible when you're financial modelling are all, a few of the many things you can do to certainly help mitigate those risks as best you can.
And speaking of risk, Ali, like one of the things that maybe get some restart projects or whatever unstuck is a bunch of debt. But instead of funding it with equity, like we saw with like Mika or Blackout and stuff recently, developers sort of maintain their desire to basically debt fund the majority of this project, right? What do you think of that?
Yeah, I mean, it's certainly pretty different to what's been happening in the gold space, obviously. But I think a couple things in the sense that they're not perhaps like some of those examples, like the Spartan Makers, Black Cats of the world, develop aren't a single asset developer. They've got other assets. They've got their mining services business as well, which, they're saying, should be making, some good money to, help during that period as well. The proportion of debt compared to their market cap, I think it's like their market cap today is like 660 million Aussie. This is a US $65 million facility. It's a pretty small proportion, not like, say, some of the other examples where, some people are getting debt facilities that are the same size as their market cap or if not more. And the reason I say that is because, say something did happen, you needed to raise equity, you needed to do something to sort that situation out. Would you be better positioned if it was a smaller percentage of your market cap or 2 times that? So those are some thoughts. But
there's another thought I had too, which is,
what did you guys think?
It's like share price is what today? Is it like
240?
240?
Mid twos.
Share price has been as high as, I can't remember, maybe 5, 6. I can't remember what the all-time high is.
Definitely 4s and 5s. Yeah.
Shareholders would probably, not want to raise money at 2s.
No.
A bit anchored.
Yeah.
Yeah. No, there's definitely a bit. Just on your point as well, Ali, completely appreciate what you're saying, though. If the market does suspect that there's a raise because there's debt trouble, then that doesn't go from being, 10% of your equity. That goes down.
It does
kind
go
of
a
quickly.
fair bit more, right?
But we'll sort of see what happens. Bill's been very adamant that there's not going to be equity dilution, and that's how he wants to go about things. So we'll sort of track it.
Yeah, keen for them to be producer.
Absolutely, yeah.
What do you guys think? One final question. What do you guys think about having the financing and the offtake all tied up from the same party? Pros and cons. Because you could see it as alignment, but then you could also see it as, if something were to go wrong, that they've got the offtake, they've got the debt as well. How do you guys think about that?
It's part and parcel of doing business with commodity traders.
Yeah. It's also another, it's a kind of ramification of a lot of the big banks moving away from financing projects. You need to go to different sources. And, since then we've seen the emergence of streamers, of royalty companies, of commodity traders funding projects like this. And royalty and streaming, they come with different problems, so kind of got to pick your poison.
Yeah. It does beg the question though, if there was a world which you could sell 20% for whatever, like some highish multiple of NPV, then why not put that money into fund the restart, or maybe there's an assumption that that's also going to go into the restart. But you could basically fund it with a strategic sell down and not have debt as well, and not dilute.
Yeah.
That's got to be on the table.
Yeah.
Right.
Well, whether the capital from a sell down goes into the restart or if it goes looking for other opportunities, I think it's TBA.
Yeah, I know what I'd do.
Yeah.
Or who knows, now that they've kind of, done the FID and they've got the financing, I don't know whether it'd be too late to, if they did get that, like a strategic partner sell down, replace the financing that's currently in place with those funds.
Yeah.
I don't know how difficult it would be to unwind that.
I don't know if you would have executed the financing if that was your plan, because Trafigura, you have to keep the offtake, and why would you want that if you didn't need the debt? Anyway,
Fair point.
food for thought.
Food for thought. But no, it would be exciting to see them be producing again at Wood Lawn.
Yeah.
Absolutely. Well done, Ali. All right, couple partners to thank. Wrap it up. Big thank you to couple sponsors in the show, Mineral Mining Services and CRE Insurance. Also, big thank you to Grounded, Sandvik Ground Support, K-Drill, Daysat, Saltbush Contracting, and the mighty Get Wet Solutions. Hooroo, guys.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.